So this officially starts Domain 1. Each one of the elements of the AFTR course has different types of domains, as I mentioned in your introduction. And this one deals with new tax law and recent updates. So it's one of those that when I refer to it, I call it a moving target because it's hard. And you know, last things I always do is like, did I miss anything before going into this day? So I kind of look at things a lot, too much. Domain 1's focus is really on the tax law for individuals. There are some elements of business in here as well, like Section 179 deductions and things like that, that might get modified. But the focus is on an individual carrying on perhaps a small trade or business, but also just being a person. And so just keep that focus in mind. This is not like a business entity update as we go through this. And basically is, are you up to date on the new tax law? That's really what the question comes into. Are you familiar with the changes in the tax law? So sometimes it's a new law that has just been enacted that we've never seen before, and sometimes it's just a change or a tweak in the law that we have. And sometimes they are what are called inflation adjustments, and that is that something changes automatically each and every year, and we're just not familiar with how that happens. So what we're trying to do in here is identify that there's a lot of things changing. And I kind of like it when taxpayers go through and ask me questions like, how do you stay up with the new law? And it's like, it's a lot of work. I mean, that's what we do during the year. That's what you see within Domain 1. As far as an overview view, I want to let you know that while there are 11 specific topics, there are not 11 things listed here. In case you say, wait, there's not enough. Because I've combined some of them because they are addressed specifically in the content specifications. I'm going to be beginning with the inflation adjustments as we go through them. And the inflation adjustments are things that come out each and every year. We've got a number of retirement changes, and specifically through the Secure Act. And our old friend kiddie tax is back again. To be honest, the kiddie tax that they passed before dealing with trust rates, I did a continuing ed course on that, and I never worked so hard at trying to explain a stupid law as I did for that. And now it's back to the way it used to be, which is the way it should be. There's also some more flexibility in 529 plans. Medical expenses, which I've got to believe there's a huge lobbying effort with the elderly to get it back to 7.5% again. And that thing keeps going from 7.5 to 10 to 7.5 to 10. There are years like, I don't even know what does the software say because it keeps bouncing, how old are you, etc. It's back to 7.5 again. And the current state of tax extenders, which is also a political football, that they'll say, we're going to give you this extender if you give us that. So it's something that has gotten a little bit better, and I will update you on those as we have. So as far as inflation adjustments, which I think is the first major key part of this area, these inflation adjustments happen automatically. They are written up in Revenue Procedure 2019-44. I'm going to actually show you that in just a moment. But basically what we look for in those are what things change automatically because of an inflation adjustment, what things occur. And so the ones that come to mind in terms of the major pieces that we look at is that income tax rates and schedules and thresholds, is that we know income tax rates are set by Congress, but where they break and go from the 10% bracket to the 12% bracket, or from the 35% to whatever, where they break gets indexed each year based upon cost of living. Standard deductions change each year based upon a cost of living adjustment. Earned income taxes and their thresholds change based upon indexed inflation amounts. Lifetime learning credit thresholds, adoption credit thresholds, alternative minimum tax exemptions, and the increase in preparer penalties. You know, the old $500 penalty? We still call it the $500 penalty, but it keeps going up like $510, $520, $530 because they get indexed with inflation. So Congress passed a law that basically said when the cost of living goes up, so do all of these things around them. So we don't have to keep changing the law every year. These are the automatic adjustments. And so Revenue Procedure 2019-44 is a document that really has a lot of information in here. And I'm showing this to you right now because I'm not going to go through all of these pieces, but this revenue procedure here comes out in 2019. And so like for next year, towards the end of the year, they will announce this information for the following year. Are all the changes in here? The answer is no. Are these just inflation? The answer is no. But as you go through a number of these, and I'm just going to drop down to like these here, where they talk about tax rate tables, the 2020 adjusted items. So what they'll say is that for a married taxpayer filing a joint return, if the taxable income is not over $19,750, then the tax is 10%. That's the amount for 2020. These have been adjusted for inflation because the year before that it was a smaller amount. Okay? And they'll do the same thing for a taxpayer who is unmarried, which is single, because you're going to see the single one in an example in just a minute. This is the amount that they use for the place where you break from the 10% to the 12% rate. And they do a bunch of those in here where they start saying, okay, this one didn't change, so it'll be the same 1,100 that it was before because it didn't reach the threshold for making a change. So this is the world we live in as we go through and try to say what changes and what doesn't. And if you've memorized a lot of rules with basic numbers, you'll understand exactly what I'm saying when we go through it. So I want to talk a little bit about how these work as we go through them. And I want to say there'll be tests on this, but there will be tests on this stuff because they're the index changes, and it's the very first thing they put in their specifications, is that when it comes to tax bracket indexing, changes in the tax rates, those have to be voted on by Congress. Okay? They have to say the rates are now this, this, and this. Okay? But where the rates break every year is not based upon what Congress passes. That's what's happened the first time. Now what happens is cost of living increases, then the rates should now break at this point before we're going into the 10% to the 12% bracket. So it goes up just a little bit. Congress modified the rules and they came up with this thing called the Urban CPI Index, which is like right in here, just so you can see it. And they use this, and they use what's called a chained approach to do its computations. None of this is really important, but what is important is that they use the CPI Urban Index for that. And you can find this in Code Section 1 of the Internal Revenue Code. You don't have to bury it. It's not hidden someplace. We can all see it. Now, just to put this in perspective, in 2018, which came off the Tax Cut and Jobs Act of 2017, Congress changed the rates. They changed where the rates broke. Congress kept the indexing language in place, which means that once we make this change, we want things to change automatically. They could have gotten rid of it and just say this is what it's going to be forever, but they let cost of living stay into it, and they changed where the threshold broke each year as well. And so by doing that, the automatic changes that took place caused us a little bit of grief when we go through and do some of our planning for our clients. So as we look at 2020, which is our current year, Congress did not change the rates. They did not change where the rates broke. But since Congress kept the indexing language in place, each year the thresholds change automatically. And that's an index change. It's a perfect example of it. And we see this impacting other areas that I mentioned at the front. I promise not to go wonky too much on you on these things, but since I'm making a reference to Code Section 1, where you find all this information, I've only got a couple of them here just so you can see how the language is placed in there. And when we look at this as a Code Section 1, subsection F, paragraph 1, so that's how you read the code, not later than December 15th of 1993. So this stuff has been in place for a long time. And each subsequent calendar year, the Secretary, that would be the Secretary of the Treasury, shall prescribe tables. Now, tables are what are in the printed books. These aren't rates, but tables are there, and they're always set up like when brackets of $50, if you remember ever looking at one in a publication. They shall prescribe the tables which shall apply in lieu of the tables in subsections A, B, C, D, and E with respect to taxable years beginning in such succeeding taxable. You're like, this doesn't even make any sense. But what they're saying is that you have to go through and set up these tables under subsection F of the Internal Revenue Code. But it goes on to say, by increasing, and this is our part, by increasing the minimum and maximum dollar amounts for each rate bracket for which the tax is imposed, under such table by what? By cost of living adjustment for such calendar year. So what the Treasury Department has to go through is go into those tables and effectively go into those rates and change where everything goes, not based on what they feel, but rather what the cost of living adjustment basically says. And then it'll go through and say, for the purposes of the paragraph, the cost of living adjustment for any calendar year is the percentage by which the CPI for the preceding calendar year exceeds the CPI for the current calendar year, and that'll be your consumer price index. Okay? So it's a simple mathematical formula. And what I want to give you an example of how this works, and these are make-believe numbers, but it gives you a sense that if you went out in 2019, you bought a bunch of stuff, you bought a bunch of food, and that food cost you $100, that would be considered to be your base period. If in the next year you bought the exact same thing, and those same things next year cost you $101, you know that you have some inflation that's going on because the same thing costs you more money. So what happens is you put the increase over your base period, and that gives you an index of 1.017. So things went up. You have a cost of living increase of about 1.7%. And what ends up happening is that if your standard deduction, and I'll use this because it's an easy thing to illustrate, last year was $12,200, and your cost of living adjustment is this 1.17. I just moved the decimal to make it a little bit easier up here. Then your new standard deduction will be $12,407, but they round everything to the nearest, in this case, $50, and it means that this will be your standard deduction next year, which is the 2020 year, of $12,400. So it's a mechanical process to set it. Sometimes it makes a change, and sometimes when the amounts are smaller, it doesn't make a change. And so just think about this as we go through and look at different items. Looking at the single tax rates for the current year. Last year in 2019, the rates broke for a single taxpayer in the 10% bracket at $9,700. This year, and I showed it to you and I just gave it a little hint in it on the publication, the rate breaks at $9,807.50. So therefore, it becomes 10% up to that point in time. And then this amount here, $9,750 up to $39,475 is taxed at 12%. Then it would go up and up after that. But for the next year, 2020, which is the year we're dealing with, since it broke at $9,875, it'll be from $9,875 up to $40,125 this year, a rate of 12%. So you're seeing these things slide up as well. Understanding how these adjustments work make a lot of sense. Very quickly, these things that we call adjustments, they basically said nothing really is going to take place for 2018 because that's your initial base year, but they will take place in subsequent years. And I'm not going to read through this, I just want you to have those in your notes. But basically what this says is that you will do this for each and every year thereafter. So let's shift back to where we are from a tax standpoint as it relates to the structure of where things begin to fit in. In 2017, our structure for determining what our taxable income was is to take gross income, subtract out any deductions for AGI, and that gave us adjusted gross income. Life was simple. We then came up with any itemized deductions, perhaps. We call these deductions from AGI, or perhaps the standard deduction. We then subtracted out from that exemptions, and you got an exemption for either a personal exemption or a dependency exemption, and that gave you taxable income. This was life as we knew it. What happens with the Tax Cut and Jobs Act, they changed a lot of that. And so since 2018, we've been living under a slightly different format. So just keep your eyes on this for a second, and then we'll go to the other piece. That from 2018 to now the 2020 year, we still have gross income. We have slightly different deductions for AGI, and we still have adjusted gross income. We have some deductions from AGI, okay? But those deductions from AGI are limited. They're smaller, and we don't see as many in there. We also have this thing called exemption amounts. Those have disappeared. They're gone. They have been suspended. They haven't been eliminated. We talk about that in a minute. But they're suspended. So they're going to come back in at some point in time unless Congress changes the rule. And they also added this new thing called the QBI deduction, the Qualified Business Income Deduction. And that brought us to taxable income. But what we saw is that when these exemptions got suspended, something had to happen. In other words, we're losing deductions that if I had a child, I got a deduction of, say, I'm just going to say $4,000. We don't get that $4,000. Well, what we got were enhanced standard deductions. And the reality is about only, under the new law, only about 13% were itemizing their deductions, and everyone else was getting the standard, so many people benefited from that. We also got an enhanced child tax credit, which also helped mitigate the fact that you lose your exemptions. So all of these things, there was no single one pattern that we looked at that was going to change things, but we did come down to taxable income under this new format. Now, as we go through and look at all of these pieces, it's important to remember is that what we do and what we talk about, filing status helps determine things. And so filing status helps determine somebody's standard deduction. And these things are also indexed, and this ties into this piece. It also determines their tax rate, what rates they have. There are different tax tables for different tax statuses. There are different tax rates for different tax statuses. It also determines the phase-out ranges for credits and deductions, and it also determines what deductions certain people get. And so one of the first things that we go through is that to make sure that we understand with our taxpayer what filing status they are. I never thought this was that much of a big deal until I started doing work for the Volunteer Income Tax Assistance Program, and I'm dealing with people I've never met before, and I don't know what their filing status is. I'm asking them questions: are you married? Are you head of household? Are you surviving spouse? And the languages and all that great with me. I'm trying my best to answer the questions. And it's like, I think your filing status is this, which is like really scary. But what I decide at the filing status level then allows me to prepare the proper return. I will refer you to publication 501. If you have questions on that, specifically look at head of household because of the due diligence rules in there. But publication 501 provided all this information in an easy to read document. And the 5 filing statuses that we have, and I'm going to hit upon them really quick, is single, which is unmarried, married filing jointly, married filing separately, head of household, and qualifying widow or widower, sometimes called surviving spouse. So those are the 5. On the form, where you used to check them, it's now up higher on the form. So you, like first time, you're just like, where's the filing status? And it's like, oh, it's way up there, and it's different, okay? And we'll see that later on in domain 2. Single, you're unmarried as of the end of the year. That's the filing status that you look at, but you may qualify for a more favorable status. So it's not unusual for somebody to meet, hey, I'm not married, but at the end of the year, but do I qualify for something else? And the answer is yes. Married filing jointly, you must be married at the end of the year, but you're considered married filing jointly even if your spouse dies during the year. You must not be a non-resident alien. You must have the same tax year end, which is important in some situations. Personally, I've never had somebody that has a spouse that has a different year end, but I have had spouses where the person is a non-resident alien. You may use different accounting methods, which is very common. You might have a business. You might be a way of recognizing income under one method and the other one does the other. That's perfect. That's perfectly fine. You also have married filing separately. You must be married as of the end of the year, and the rule that you have is that you both must either itemize your deductions or both of you claim the standard deduction. So there's rules that pertain to that. And then finally, head of household is the next one. You're not married at the end of the year. Your spouse has not lived in the home for the last 6 months. You maintain the household, which is more than 50%, for a qualifying individual or an unmarried son, daughter, or grandchild, and any other dependent as well. There's also a way of being, in certain circumstances, because I just finished a tax return, somebody who's still married but is considered to be unmarried for head of household status because they've been abandoned. So there's different rules to all of these, which is to say the publication, take a look at it, but that won't be on the test. The basic core rules that we're covering will, because they help dictate the things that I'm going to say next. And the last one is qualifying widow or widower, where you are sometimes referred to as a surviving spouse. You are unmarried at the end of the year. You maintain a household of more than 50%. You have a qualifying child. And you get this for 2 years after the death of your spouse. So if your spouse dies in this first year, then you can file married filing jointly. In the year after that, and the year after that, if you have a qualifying child, you will get the surviving spouse or qualifying widow provision, which basically gives you the same provisions as if you're married filing jointly. So it's a very favorable tax status to do that. Once you pass that 2-year period of time, you then go to a head of household status. So with that, I've got a question for you. I'd like you to take a minute and read that, then I'm going to put some numbers to this. So if your spouse dies during the year, you are considered married for the whole year for filing status purposes, and that's correct. Okay, that's a true statement. Okay, here's a second one. Karen's spouse, John, died during the year 2019. She has not remarried and supported their 5-year-old son all year long. She qualifies as qualifying widower with dependent child for the 2020 year. And the answer is true. In the 2019 year, when her husband passed away, she would be married filing jointly. And for this year here, she would be qualifying widower as well as qualifying widower the next year. And one third one, take a look at this one, a little bit longer. Mary's husband died in 2017. Her son Bobby is her dependent and has lived in her house since his birth in 2010, so it's young. In 2020, Mary may file as qualifying widower because she has not remarried. Well, in 2017, she'd be filing jointly. In the next 2 years, which would be 18 and 19, she'd be filing as qualifying widow. And in 2020, she would be most likely qualify as head of household status if she meets those tests. So that's kind of the procedure that you would end up going through. So once you've established the appropriate filing status, the next part is just the mechanical component. And so the first thing I want to do is talk about some of the inflation adjustments as it pertains to standard deduction. So if you recall what you had in the previous year for 2019, this is basically that column that we have there. And that the standard deduction for a single taxpayer was $12,200. If you recall, the year before that, it was $12,000. So it's been indexed up each year. But for the 2020 year, we go over into this column, and that amount has been indexed up from $12,200 up to $12,400. The married filing jointly has also been indexed up to $24,800. The married filing separately, which is half of the married filing jointly, is $12,400. The surviving spouse stays the same amount as married filing jointly. And the head of household is the only one that doesn't really break quite as even as I wish it was. But it's not exactly halfway, but it's so close between it because of the indexing rules. It's $18,650. So our focus is on this column. And just so that you know that, on my next slide, I just put those amounts for these 5 categories so you can see them as a quick reference guide as we go through and do it. But I wanted you to see, because the focus of this is inflation adjustments, to see how those things basically changed. There's one other part of an adjustment that we have, and this is called the additional standard deduction. This is for a taxpayer who's 65 or older, and technically you turn 65 or older on the day before your birthday. So if you were born on December 31st, for tax purposes, you're actually considered 65 or older, whatever that birthday is, as of for the next year, which is kind of like cool. But that probably won't be on the test either. I don't remember if it is, but it's just like fun facts for people that if you have somebody that's a December 31st year-end taxpayer, there's the rule. If you're blind, which means you cannot see greater than 2200, or your field of vision is 20 degrees or less, you're considered to be legally blind. If you are one of those 2 people, you get an additional standard deduction for each element. So in this regard, the 2020 rules have not changed any of the amounts. So they were $1,650. They are still $1,650 if you're single or head of household. And they were $1,300. They're still $1,300 as you go through this piece as well. So no changes there. And it's for each person. So if you're married and file a joint return, you each get, if you're 65 or older, you get $1,300 and $1,300. The inflation adjustments, I keep this slide up because I know it's going to change next year, undoubtedly. But you will notice that the entire column here equals the entire column there. There are no changes in it. So this is like an easy one to remember, that there are no changes. Now, with those numbers, and I know you have them on your PowerPoint so you can see what they are, let me give you one more adjustment, and these are for other adjustments. If you have a taxpayer who's a dependent of yours and goes to file their tax return, they get a standard deduction of $1,100 automatically. Now, their standard deduction can be more than that by taking the amount of their earned income plus $350 to come to the new one. So if you're a child that earns $1,000 working in a supermarket, their standard deduction is the $1,000 that they earn plus $350, or $1,350. If the child is your dependent and makes more than $12,400, they would get a $12,400 standard deduction. It goes up to that amount, but they have a base amount for $1,100. That's important for when we talk about the kiddie tax later on, which is why I put this guy in here right now, because this is something that it did not change as far as indexing goes. The other one that we have is called the exemption amount, and the exemption amount used to be the amount that we could claim as an exemption if somebody qualified as your dependent. Now, why is this important? because when you do the earned income test, or when you do the, when you do the test for who qualifies as your dependent and the person is an other dependent, one of the things they look to is that, do you have any disqualified income? Did you make too much of income which would make you not be a dependent of the taxpayer? And the answer is yes. I made more than $4,300. Now the $4,300 doesn't show up on the tax form. It is a test that we run through to determine whether or not it qualifies as a, what we sometimes refer to as a qualified relative, as opposed to a qualifying child. A qualifying child has no income test. It's just basically a support test. A qualified relative does have a gross income test. So this number has to exist because it's used in different places in the tax law. And it's also, I want to wrap up with one sort of like computation thing, just so that you know, is that if you have a taxpayer that's single and they're 65 or older, or 65 or older and blind, how do these factors basically work together? And what ends up happening is that you begin to sort of cobble together parts. This has been, on many professional exams, a very basic step on who is required to file. So walk through this with me as we go through. If a taxpayer is single, they're required to file a tax return if their gross income exceeds the standard deduction. The standard deduction is $12,400. Okay? So that becomes a threshold number, pretty easy to figure out. Somebody says, I made $10,000, do I have to file a tax return? It's from a W-2. It's like, you don't have to because you're under the threshold. You may want to if you're going to get a refund. Okay? If the taxpayer is also single and 65 or older, that would be $12,400. That's their standard. And 65 or older, if they're single, has the additional standard deduction, if you go back to the previous page, of $1,650, which would be like $14,050. So it goes up a little bit because they get an additional standard deduction. And if you're dealing with a taxpayer who's elderly and perhaps legally blind, it'd be the $12,400 plus $1,650 plus another $1,650. And I had $15,700 for that. But it gives you the ability to make a determination when you're talking with somebody, is does that person have to file a tax return? If I go to the other one for a married taxpayer filing a joint return, I could do the basic parts, but I'm just not going to write all the things there. When you have married filing jointly, you've got the $24,800 as the filing status. The married filing jointly status has that standard deduction. If they're 65 or older, their additional standard deduction is $1,300. If they're 65 and older and blind, they get $1,300 plus $1,300. If they're both, okay, you can just keep adding up the numbers in there, which is why this slide would get messy. But the key elements that we have here is what is the standard deduction and what's the additional standard deduction for each one of those 65 or older. So with that, I think that's a great place to break, and we'll go on to another topic.